Hello everybody. Today we are here to talk about the retrocession market in Asia Pacific, and I'm here with Ben Dunnett, Managing Director of Global Specialty Asia Pacific from Carpenter. Morning, Ben.
Good morning.
Good morning. Hi. So, Ben, why don't you start by telling me about how would you categorize or characterize the retrocession market in Asia Pacific, this year, today? What is it like?
I think there's a broad consensus, certainly over the last couple of renewals, that the market is no longer a hard market in the sense of rising prices, and I think that consensus went very quickly from anecdotal evidence, from sitting with underwriters who were talking about their portfolios, and moved into something that we could see statistically. So we have that under our own analysis, and you can also see from some of the earnings reports from some of the reinsurers that the pricing is falling. So then, are we in a soft market? I think that is the question, and I'd like to make the point that although prices are softening off, we're actually coming from a much higher base. Okay. In terms of the last few renewals. So we call it in the retrocessional space the Great Reset of 2023, where retentions went up alongside pricing and terms and conditions were tightened. So we think that there's actually a lot of value that was taken out of the retrocessional space, volatility passed on to reinsurers that can't adequately be demonstrated by price. So although prices are softening, we would probably characterize this more as a transitional market. So we like to use, Carpenter, we like to use the Dowling wheel as probably a more nuanced look at the hard, soft cycle. And obviously in the Dowling wheel, you have a restoration phase, the hard market phase, where there's discipline in underwriting, you're looking at profitability. Moves very quickly and quite pejoratively into what they would call the cheating phase, which is going for market share essentially, and a lot of competition. And what's interesting about the Dowling wheel is there's no differentiation between the two. It's an instantaneous move. We see this more as a very short cycle transitional phase. We're not quite in the cheating phase, the market share phase, but neither are we in the phase of higher pricing and less competition. We do have more competition within our section of the industry at the moment.
Right. So how long do you expect for this transitional phase to last before it moves on to the next phase?
It's a great question. I think it's going to be short, and I think it will be to do with the next phase, the next cycle will really tell us whether we've hit a very soft market. Right. Or whether we still stay in the transitional phase. So thinking back to where the value is in the chain at the moment and what's been removed in terms of terms, conditions and retentions, we would expect that to be, if not a battleground, then an area that brokers will be pushing for their clients to see what stage of the cycle we're at. And we would also expect a higher demand for limit and volatility covers in the coming 12 months as well. The availability of that, again, I think would demonstrate what part of the cycle that we're moving into. Okay.
So another thing about when it comes to retrocession is capacity, right? So where is sort of capacity currently located and where is it constrained? Can you explain a bit more?
Absolutely. I think a lot of the messaging that's gone around over the last 12 months has talked about an abundance of capacity. I think it's a discussion point at all the conferences I've been to recently, and I'm sure it will be for the upcoming SIRC, for example. How much capacity is there? For retrocession, it probably would be better characterized as suitable rather than abundant. So, roughly speaking, there's about 649 billion of dedicated reinsurance capital. Some brokers have it slightly higher, depends on how you put it together. That's a 7% growth on last year. It's a 50% growth on where we were in 2018. Now that obviously suggests a significant amount of extra capacity. But we can also look at a bottom-up approach now that we've had the last 12 months of data, and we can look at individual layerings at written versus signed, because we think it gives a better show of exactly how much capital is actually being deployed. Right. And by the way, retro as a hedge into the dedicated reinsurance capital, it stays roughly the same at about 6%ish. So it moves with the capital. When we look at written versus signed, it's in and around, it differs by products, but it's in and around about 125%.
Right.
In the hard market, you couldn't get to 100%. In a very soft market, it tends to go up closer to 200. So that kind of gives you an idea that there is sufficiency of capacity. There are variations, obviously, across, and I think we could probably put that across two areas: territorial scope and product.
Right.
And if we look at territorial scope, by its nature, as something of a proxy capital, retro tends to be multi-territory. Because it's multi-territory, many deals can very, very quickly exhaust people's non-US peak peril allocations. So there's potentially a bit of a constraint around some of those larger perils. I would point out that solvency levels are at record highs in the past couple of years, so there's probably sufficient headroom for that.
Right.
In terms of products, yes, there is a lot of there is some products that we would like to see our markets give some more capacity to our clients just to help grow the market. I think that's three places. One would be risk. It took a long time for the risk to lose the decile 10 stigma that it took in 2018. But it's been 6-7 years since then, and the results have been excellent. So we'd like to see some more capacity in that space. Second would be aggregate. At one stage in the retro space, we were 50% aggregate by limit.
Right.
It's now down closer to 10%.
Okay.
So there's a lot of room there to grow some earnings and volatility coverage for our clients, and we would like to see more in that space. It was very encouraging at Monte Carlo last month to hear several markets talking about possibly providing that in the future.
Okay.
And then the third would be quota share. I think the capacity is there. I think where we as an industry need to work over the next couple of months before 1/1 is to bring together the expectations of both parties. I think that the sellers are very confident looking forwards and would like it to be shown on reducing combined ratios. The sellers, they still work to retrospective data, and they still see a slightly less of a margin. It would be great if we could have the capacity to kind of meet in the middle there.
Okay, right, cool. So, speaking of the 1/1 renewals, what do you think the rates are going to be like? Are the current rates, how are they compared to like direct reinsurance rates? Or similar exposures?
Yeah, that's an interesting question. It's something of a thought experiment, isn't it? Right. So can you directly compare for per unit of risk, say reinsurance to retrocession? If we spoke to our clients, the answer would probably be yes, and it's expensive. But in reality, I don't think they're directly comparable because they look at different parts of the risk curve and also the capital stack. Retro is by nature more volatile. There's more unknown aggregation and accumulation. You can't hedge retro in the same way that you can with other parts of the value chain.
That's fair.
And because of that, it's very, very capital intensive, and therefore the pricing is not directly comparable. What I think is comparable is the relativities, and this is what we like to talk about with our clients. We've seen the relativities of direct to reinsurance to retrocession as something of a U-shaped graph over the hard market. Direct pricing moving on at quite a pace. Reinsurance pricing moving on, but not quite so much. Retrocession also jumped and moved at quite a pace. Pleased to say, I think over the past 12 months and the upcoming renewals, it's going to flatten. That U-shape is going to flatten a little bit. Retrocessional rates have come off quite significantly over the past couple of years. Direct rates have also started to slow and decrease in some places. Reinsurance rates, yes, they've dropped, but not to the same extent. And I think as evidence for that, you could maybe look at global cat losses for this year, up until this point this year. Reinsurance markets typically were taking about 20 to 22% of global loss.
Yes.
It's reduced down. At the moment, it's looking at about 14%. It's direct evidence of a change in structure and also a better risk to price metric for reinsurance. So we would say that that's a flattening curve, which is a positive for our clients.
What kind of pricing trends have you been seeing over the past year?
In terms of pricing trends, I think we are looking at two areas really. One is, where are we getting the most price advantage for our clients, and the other is what's happening with the structuring of the programs in terms of pricing. On the one side, when it comes to pricing for our clients, we have always seen a trend that more exposure into the retro space leads to better risk-adjusted rate change. And a lot of the focus of our thought leadership pieces and the conferences that we've given over the year has been to try and encourage some of our clients to take a re-look at their capital stack and where retro sits within that. And our suggestion would be, as the market softens off, that you should be looking to grow into your retrocession, perhaps purchase more and perhaps take more advantage of dropping pricing. So more risk equals better risk-adjusted rate change. Ultimately, we're still a diversifying market share industry, and holding an absolute price or increasing an absolute price is much more attractive to markets than it is to drop absolute price. So that it's in the increase in risk that we see the biggest advantages. In terms of how that's played out in a program, a typical program, we see a lot more soft market features coming in. To give you an example, split retentions to allow you to retain less for your lesser exposures and perils. 12 months ago, not really in existence. As of a few months ago, about a third of our programs now have split retentions. That's a very, very quick shift, and shows where our clients can pick up the most advantage. We're also looking at longer stretches, which is again a softer market tool for getting more value into your program, so you get lower reinstatement costs and more sideways coverage at a lower level. So those kind of larger limits and larger programs, we're starting to see that come into the market as well. Okay.
So I guess for my last question, we've been looking back. So how about we look forward? What's your view, what's your outlook of the retrocession market, say within the next 12, 24 months? What do you think is going to happen?
I think it's inevitable that if everything is to remain the same, that prices will continue to reduce. I feel there are too many push factors for that not to happen. There are new entrants into the retrocessional market. It's not enough to call it a class of, like we would call a class of 2006, for example, but there are some additional new entrants. There is more capacity for retro markets that are already in play at the moment. We have some very high ROEs to service, and that means necessarily growth. So all things being equal, I do see pricing, risk-adjusted pricing reducing. I think maybe in terms of this upcoming 1/1 and maybe over the next 12 months, the area of discussion will be terms and conditions, secondary perils, retention levels. We would very much expect to see our clients seeking out some lower volatility cover, some peak peril coverage, some earnings protection. We as brokers are always looking for the panacea of earnings and capital protection. And as we move towards a softer market, you tend to be able to get that closer in one product. So we would see pushing at those levels. One thing I'd perhaps like to end on that, and as a retrocessional broker, it's quite interesting because you have to wear both hats. Your markets are often your clients are often your markets. It's not enough to say one way pricing down is good or pricing up is good. One thing that was suggested in a recent conference actually by a market veteran in an insurance side, which gave me pause for thought, was that he was talking about the fact that actually global uncertainty and relatively high investment returns have bolstered the results in our industry. Paradoxically, they've also stopped new entrants from coming in. And I think the point that he was trying to make was we shouldn't fall into the trap that there is a lot of margin in the underwriting side that should be passed further down the chain. Actually, there are other elements that are keeping this return on equity high. And we're only really one loss away from profitable underwriting books on the retrocessional side, which has only been for the last couple of years, turning down again into the negative. So I think his point was that I would fully believe in that ultimately, as a section of the industry, we are very much at the whim of whether the wind blows or the ground shakes.
Okay. Well, thank you very much, Ben, for
Thank
your
you.
insights into the retrocession market here in Asia. It's been a pleasure. It's been nice talking to you.
And you.
And thank you again.
Thank you very much.